And 3, 2, 1.
All right.
All right. Welcome to the show. Hope you guys had a fun but uneventful 4th of July. 10 fingers, hopefully. 10 toes.
Yeah.
Nobody blew anything up.
Yep, it was an interesting week. You have a holiday in the middle of the week and everything gets all disjointed and people take off before the holiday and after the holiday, and it definitely is like that on Wall Street. It was a pretty slow week.
Yeah, uneventful. Which is, I like that every once in a while.
Yeah, I mean, it can be usually, almost always the 4th of July is positive. Almost always.
Nobody wants to mess it up in Independence Day.
Yeah, no. It's almost always a positive week. Actually, the first two weeks of July are almost always positive.
It feels weird to me, though, because I know we're kind of in the same boat. Well, we are in the same boat, but, I didn't even remember that. I mean, I know we're at the first of the month. I know it's July, but I'm not picturing it being the 4th of July and as a holiday. And, right. The holiday falls on a Thursday, so most people are going to take off Friday, and there's going to be this 4-day weekend where, there's nobody around, right? Right. and I wasn't prepared for all that. I'm like, because we just, first of all, we work mostly every weekend and kind of chill out on Mondays. And, we have our schedule because of the market and what we do and all that. And we're retired, so we pretty much make our own schedule anyway. So it's just being discombobulated. Yeah. Anybody that's retired out there,
I'm sure they get it.
Tell us if you have the same feeling. The biggest joke is every day is Saturday, but really I feel like every day is Tuesday.
Yeah.
You know what I mean?
Yeah, much more like a Tuesday than Saturday.
Yeah, every day doesn't feel like a Saturday. It feels like I do a little work every day or something, and it's just spread out. No complaints, though. No complaints.
No, it's all good.
Yeah.
But it does make for an interesting week on Wall Street. I think we talked about the newsletter or the podcast last week, but there's a lot of potential for volatility in a week when everybody's at the Hamptons, if you're a Wall Street guy. So this week was up. Friday, it's about noon. Jobs report came out, and unemployment ticked up to 4.1%. That's kind of a big deal. The most interesting thing I thought was the new jobs created. I can't remember the number. It was quite a bit less than expected, and it was quite a bit less than last month. And then last month got revised down. So the economy is definitely weakening, but I think it was 160,000 jobs created. And out of that 160,000, 70,000 of them were government. And last month, they had a bigger number of jobs created, and only 25,000 of them were government. So the economy, minus the government, is certainly weakening. And unemployment ticked up to 4.1%, which may or may not be a line. I mean, everybody's not back at work, so next week we could see. But again, still bad news is still good news. So all those things, the economy weakening means the Fed cuts rates sooner, which is good for stocks, is the way the story goes. And so the market's up today. Whatever, it's going to keep going up until it doesn't. All right. So. The most interesting thing actually that happened at the beginning of the week, so I feel all disjointed because I wrote this, slide deck throughout the week, and so many things happened, and they're all completely different. But the biggest thing that happened was really bonds. When PCE, so PCE came out on Friday morning last week, so 7 days ago, and it showed inflation not coming down as much, and let me see if I can get this straight. I have it on another slide. Anyway, the expectation was that the market should have gone, or bonds yield should have gone up, and it went way down, and so the F fund went crazy in TLT, and we had a bunch of questions in the Facebook group and all that. So we'll get to some of that, but I have this one question that I kind of wanted to go over, and then we'll talk about what happened with bonds, because there's basically 3 scenarios, or anyway, 3 possibilities. There are probably more than those 3, but we'll go over 3 of them. Silver, really interesting right now, and the TSP fund charts. So, okay, I am less than a year from retirement. So we're not talking about somebody who's just starting their career. They're less than a year from retirement. My funds are in G. Should I leave them there? We got like 100 comments on this, and almost all of them are absolutely you should leave it in the C, and if you could get C cubed, you should put it in there, and all that. So it doesn't, I don't say frustrate me, but when you ask a question like this, I almost think it's a bot, to be honest. I kind of wonder sometimes if people are actually throwing like that vague of a question, and are they going to take the information that they get from the answers and use it for something?
Yeah, I can't think that bots would be that sophisticated, but then again, who knows?
So no offense to whoever asked the question. That's not the point.
Yeah.
I mean, everybody has this question.
I think it's a valid question. It is. For sure. It's a valid question. And what it does is it reinforces why we even started doing this show.
Sure.
It reinforces it because the fact that so many people, our peers, our friends, our acquaintances and stuff that's in the government and military, they just don't really understand the TSP and how to use it, particularly throughout their career, right? And so there's always this confusion about what to do and how to do it and all this, and it's just it's a huge deficit in education that I wish, honestly, like the government would take it up as a problem and say we need to educate our folks.
I mean, the military's starting to do it.
They are. Yeah. They're. I don't. I question how well they're at it, but who knows? They're trying.
They're trying.
Right.
Yeah. But so something like this, right? I'm less than a year from retirement. I'm in the G fund. Should I leave it there? It depends on what you're going to do with the money. Like at the end of the day, that's
almost not a investment advisor question. It's a financial planner question.
Right.
That has as much to do with. It has more to do with what you plan to do with your money.
That's right.
Than it does what's happening in the market.
100%.
You got to figure out what you're planning to do with that money. Then you can figure out where to put it. Right? What are you planning on doing with it? Right. Are you going to keep building it? Or are you going to take it out and do some stuff with it? Like, there's a lot of questions in there, right?
Right. So if you're less than a year from retirement, let's say, for example, you want to pay off your house, right? You want to use your TSP money to pay off your house because you don't want to worry about that expense when you're retired. Should you leave your money in the G fund for the next year, gaining, say, 4%, knowing that it's not going to go down, and then you can plan on the amount that you're absolutely going to have so that you can pay down or pay off your house or whatever. If that's your plan, you do not want to move it out of the G fund. I mean, if you're going to use that money in retirement for something that you've already identified, hoping that you get some continued returns over the next year in the G fund, because if you do that, then you're taking the risk of the C fund going down. So it comes down to your personal circumstances and risk tolerance. But if you have something identified for that money to do in retirement, you want to leave it in the G fund. There's no wiggle room there, If you don't need that money and it's just spending money for you, then put it in the C fund. Get whatever gains you get, and if you take some losses, it didn't matter anyway, so you don't get so much spending money. But it depends on your personal circumstances and risk tolerance. So at the end of the day, figure out what you want to do with that money, and then get a financial advisor that can kind of help you. But yeah, it depends on your personal circumstances and risk tolerance. Okay. So what happened to bonds? So I feel like this is going way back, but it was at the end of last week. So Thursday night, we have the presidential debate. Friday morning at 8:30, we get the PCE numbers, inflation numbers. And then overnight that night, we had something going on. Well, it's been going on, but in Japan with the yen. So those were the three big things that affected bonds Friday, Monday, and Tuesday. Okay. So what happens at the presidential debate? So this is a MarketWatch article. July 1st was that? I can't remember the dates right now. I don't know if that was the Friday after the debate. But Trump victory could fuel more inflation. Okay, so there's this idea that if Trump gets elected, the tariffs, the idea that he's going to charge like a 10% tariff on everything, and part of that, the way the story goes, would be offset. We wouldn't pay income tax, and all of our income taxes would be transferred over to tariffs. But if you put tariffs on there, it's inflationary. So the consensus view was that Trump is likely to take the White House and implement policies that would be much more inflationary than a second term with Biden. So that was the big takeaway in what people were saying, why bonds, why yield was going up, right? Okay. Yeah, so Trump's proposal includes a 10% duty on all imports, minimum 60% tariffs on Chinese goods. So it's all going to be inflationary. So that was the one possibility of why yields went up. The next one was PCE, right? So Treasury yields finished higher despite May's PCE data. So the May PCE data, let's go to this part first. So the data released on Friday, no increase in prices was seen in PCE, right? So inflation is not going up. The economy's rolling over. Inflation is not going up. Yields should have gone down on the PCE data. They should not have gone up, okay? So the interesting thing here is yields actually did go down. PCE data came out at 8:30. At 10:30, yields began to reverse direction. From 8:30 to 10:30, yields were going in the direction they were supposed to go. And then at 10:30, everything flipped. And yields went way up on the day. And that was on Friday. And on Monday, they went up even higher, right? So the initial idea, okay, if it looked like Trump was going to win based on the debate, Trump's policies would be inflationary. That's why yield goes up. PCE comes out, yield goes down like it's supposed to, and then 2 hours later, it spikes again. And nobody seems to know why. Okay. So one of the possible scenarios is dollar versus yen. So we always think that, the Fed lowers rates. What the Fed does matters, right? But our dollar is affected by the euro dollar market is bigger than the dollar market within the United States. And so the amount of dollars that other countries own, right? If something happens in a country that owns a lot of our dollars, that can have a big effect on U.S. treasuries, okay? Because countries hold U.S. treasuries and then sell them for dollars, and then if you have to buy like a barrel of oil, right? Oil is traded in dollars. So if you're in Japan, you have U.S. treasuries, you sell those treasuries, you get dollars, you buy your oil. Japan they're the biggest. They are 1.187 trillion in treasury securities as of March of 2024. So everybody talks about how China, our debt, how China owns all of our debt. It's actually, they are the second highest, but Japan is higher. So Japan has a really low or negative yield right now, and our yield on our treasury debt is higher than theirs, so they're getting a better rate of return for holding our treasury than holding yen. Okay. So what happens is, so this is a chart of the dollar versus the yen, okay, in black, and our yield, so our 10-year yield, right, which peaked out at 5%. So our 10-year yield is in orange. Most of the time, when the dollar versus the yen, so this is how much a dollar costs versus a yen. So if the dollar is increasing in value versus the yen, it means that the value of the yen is going down, right? And that tends to go along the same direction as treasuries. So there was some kind of big deal up here at 160, and I don't really understand why, but there's all kinds of hand-wringing when dollar yen gets above 160. And the Japanese central bank started managing their their currency in March. So the thought is this is where that divergence started happening. We've seen a ton of these divergences. We've done them on a bunch of different podcasts. But dollar yen keeps going up and treasuries go down. Why would treasuries or our yield go down when dollar yen goes up? It takes you much more yen to buy the dollars that you need to buy treasuries. So at some point you have to sell the treasuries off because you can't afford it anymore, basically. And so the thought is that that's what this divergence is from. I don't know, if that's the case. If Japan, who owns the largest amount of our treasuries, if they start selling off treasuries, then yield would go up, which started to happen, and that's what freaked everybody out. And so yield went up for a couple of days. It's since reversed completely and come back. So everything is fine. So at the end of the day, those are three things that happened, and they are three possibilities of why we had this crazy spike in yield. But it seems to have come back, and now we're back to normal. So it was definitely the most interesting thing going on in the beginning of the week, and it was kind of a flash in the pan. I have no idea why, but those are three possibilities. Okay. Silver. So I wanted to put this up just because it's a really good kind of teaching tool. You got this giant move off the bottom in COVID in silver, right? And then it consolidates basically sideways. You get this kind of saucer kind of pattern. And we got a whole bunch of tops. Almost looks like the iPhone, to be honest, but you get a whole bunch of tops. And then we had this breakout, right? A few weeks ago, this is a weekly chart. So a couple of months ago, we had this big breakout. And then price slowly consolidates back down to what should now be support. Because over here, it was resistance. Can't get above it. Then we have this big consolidation. Take a couple of weeks of trying to get above it again, and then have this big breakout, right? Then we get a retest of the breakout right there, and then a big up week for silver. So the implication of this chart is that after this, 2020, 3-year consolidation in silver, this is the beginning of a big move higher in silver. That's the idea. It gets confirmed when it gets above that high. Just a way that you use the charts to figure out if you bought silver right here, you bought it because it retested, right? And as soon as it started going up, if you bought it there, that was the lowest risk place you could buy it. Because if it went against you and closed below the bottom of the channel, you would just get out. So you have this huge potential of an up move, and this is your risk. Okay. TSP fund charts. So again, not too much to talk about on the weekly chart. If you're following along weekly and you're using that 20-week moving average line, as long as you're above that line, you want to be in the C fund. When it gets below that line, right? You don't want to be in the C fund. These are Fibonacci projections to figure out some potential targets for how high price might go. So I put up the 1.414 extension from the top in January 22 to the bottom in October 22. And so this distance, 1 times 1.414 gets you to this line, times 1.618 gets you to this line. So this first target at 1.414, for 2 weeks we hit resistance there, but then this week we got above it. Okay, so the next target would be the 1.618, which is 58.81. This is on a logarithmic scale. Okay, so if you look at it on a regular price scale, it's a little bit different. So it's the same Fibonacci extensions, but it's a little bit different. So we're well past that 1.414, and now the 1.618 is 56.42. So somewhere between 56.40 and 58.80 is a pretty good target where we should expect some kind of resistance. Doesn't mean it has to stop there, just that we would get some kind of resistance at that level. S-Fund's been the same for a while. It's in this triangle consolidation pattern. Until it gets above this line or below that line, you don't know which way it's going to go. I mean, it can do all kinds of things in between. If it breaks to the upside, great. If it breaks to the downside, great. But for now, anything you're doing in the middle there is kind of guessing. And the iFund is the simplest one. It's got a triple top back here in 2021. Couldn't get above it. So 82 is the number for the iFund. EFA, it's not the iFund number. It's the Europe, Asia, Far East Index. But 1, 2, 3, 4 weeks couldn't get above it. Got rejected really hard a few weeks ago and came down to this upsloping trend line. So we're staying above that line. We got a pretty good breakout this week, but it doesn't really mean anything until we can get above 82. And then the F fund, this was everybody's big concern, and a lot of people are talking about this on Facebook. Why would you want to be in the F fund when the C fund is, making 15% and the F fund is down for the year? Well, what you're trying to do, if you think the C fund is just going to go up forever, then yeah, why would you look at any of the other funds? If you think that there will be a top at some point in the C fund, you want to look to see where you would want to reallocate into. So your options are only the G fund or the F fund. The G fund, you're going to get your rate of return is whatever if the Fed lowers rates, which they will, the lower the rate, the lower the G fund rate of return. The lower the rate, the higher the F fund rate of return. So and the F fund is really historically undervalued, and we got this head and shoulders bottom pattern, right? Left shoulder, head, right shoulder. When we break this neckline, we get up here somewhere, price is going way up on the F fund. So if I have to choose, if I'm looking forward and I'm saying, okay, I'm anticipating the C fund at some point topping out, I'm going to look for the F fund. It breaks that neckline. It's the only option for us in TSP if the C fund is going down. It's the best option of the G and the F. Right? So that's why you would watch the F fund. It doesn't mean you should buy it now. It means you should watch it because you want to have a plan for what happens when the C fund rolls over. Unless your plan is the C fund never rolls over. And if that's your plan, good luck to you.
That's not a plan. That's hope.
Yeah.
And hope is not a good plan.
No, not a plan.
It's right there. Just got to read it. Hope is not a good plan. All right, guys. Hope you enjoyed the show this week. If you liked it, share it with your friends. If you have any questions, you can shoot them to us in the comment section wherever you found the video. If there's no comment section, you can always shoot us an email at support@growmytsp.com, and the support team will get it over to us. All right, guys. Hope everybody had a safe weekend, and we will see you next week. We're out of here.